Hello, my name is Mukarram Mawjood. I'm the founder of Bullionite, and I'm here today to give you Blackstone Commodity Group's view on the markets. I know that there's a lot of significant events that have happened in the last 2 quarters. If you look around the markets today, right? And I know a lot of people are concerned about the significant volatility that they've seen in the different asset classes from the first quarter of the year and the second quarter of the year. So I'm here today to cover some of the major things that have unfolded over the last 2 quarters. One, I would definitely say, and it's on everyone's mind, which is the coronavirus situation and the coronavirus-induced market volatility. That's how I call that. And then obviously the next major thing that's coming up, which is the US presidential elections, which has always been a massive fundamental event over the last 20 years or so that I've been looking at the markets and trading. Now, the other important thing that I'd like to cover today in a fundamental kind of overview of the markets is what I call the post-COVID economy. And how will that look like? And understanding what you as an investor, or you as an individual who has retirement accounts, or you're involved in the market, how do you adjust your thinking towards a post-COVID economy? And I think that kind of information is very powerful because it will prevent you from a lot of pain, especially in the markets and in your accounts, okay? And then the final thing I'd like to touch on a little bit, which I think would influence the markets, is the US-China trade tensions. And obviously this has been a theme over the last year or year and a half, but it has kind of escalated over the last few months, and I will go into that a little bit as well, okay? The other thing that I'd like to give an overview today of is the different asset classes. So in this video, I am going to spend time in covering the specific asset classes that were affected by some of these events that I just talked to you about: the coronavirus, the US-China trade tensions, the presidential elections coming up. And I will try my best to cover the issues that happened in the equity markets, especially with what happened in March, what's going on now. And then, and I know everyone will be very excited about this, we'll cover the gold and silver market, the precious metals market, because they have had a massive run-up in the last few months, and we want to analyze what does this mean, and how much more of a run is there in the precious metals market. Is this similar to what happened in 2008, 2011? And we'll go into a lot of data. That way you can kind of come out from this video with real actionable information. Okay, so now let me get into the different asset classes that I talked about in terms of kind of dissecting in this market analysis video, right? Or I call it also a market update video. Now, the first asset class that I want to kind of look at is the equities market, because I know that a significant portion of people, or a significant group of investors, you're invested in the equity market, whether it's in the form of a stock account that you have, or whether it's in the form of a retirement account like an IRA or a 401k. I know that most people are exposed to the equity markets, and I know that I want you to learn and understand kind of what's going on and what could happen, right? So first, I think everyone who's involved in the equity markets has realized how volatile it got in March after the coronavirus situation kind of came across the pond, and now it affected the United States, and we were all going into lockdowns and things like that, right? So just to break it down, in March, the important thing is all of the indices. If you take the Dow Jones, the S&P 500, the NASDAQ, across the board, they had a massive drop, and in the Dow Jones, we dropped more than 10,000 points within about 6 weeks or so, okay? Now, here are the important things that I want you to pay attention when I talk about this market, and I think the things that I want you to be concerned about. One, I know that there's been a bounce in this market since that drop. What does that bounce mean? Secondly, that big drop, what does it really mean? Okay, so I want to kind of dissect that. Usually in my videos, you know that I'll talk about the fundamental events, and then we'll kind of shift over and show you the charts, do a technical analysis. And in this segment, we'll try to do that. If not, there'll be a follow-up video where I'm analyzing the specific market that I talked to you about on a chart. because I didn't want to kind of combine all of it together. So this is a good introduction, and then you can come back and watch the other video as a segment to this, okay? Now here are the important things as a trader and someone who trades the markets and someone who's been in the industry for a while that I saw. Number one, first realize that the Dow and the S&P 500 and the NASDAQ, all of these markets, they have been, before March, they've been in a 13-year bull market. 13-year bull market, okay? No matter what anyone says, no matter how many different angles you can come up with, you need to understand that is an extraordinarily extended time period for a bull market. When the average bull market in the United States is around 7 to maybe 9 years or so, we're now in the 13th year and going, right? So first, you should know, as someone who wants to protect your funds or wants to protect your profits, that market, the equity markets, is an overextended market. And here's how overextended it is, right? In 2007, October, when the big market crash happened, it was at 14,700, the Dow. Then by 2009 March, the market had dropped to like 6,600 or so, okay? A big 50% drop plus, right? I'm not going to get into exact numbers. But since then, from 6,600, this market, the Dow, has come up to about 28,000 plus. I mean, come on. If you're in that market and you've been fortunate enough to increase in value, first, I would say maybe get back some of the money that you lost, and then increase in value and continuously go year after year after year to a high of 28,000, almost coming close to 29,000, you have to understand that the highest probability direction for the stock market is for it to come down. That's why whenever something major, fundamental happens, you see a sudden, like an earthquake or a big shock wave, suddenly the market crashes. Because the primary reason, and I always teach this in my sessions on Bullionite, in my video lessons, I say that you always have to look at the highest probability direction of a market. That's how you can be part of a trade or an investment that can accumulate and grow significantly. It doesn't matter whether you're right or I'm right, because the market doesn't care about that. The market is always right. So whatever said or done, you know that this is an extremely overbought market and a long-term trend. Secondly, you know that the highest probability direction for this market is to come down. Even though, let's say if some people say, oh, well, I think it can go to 30,000. I think it can go a little higher. Okay, great. Let's say it goes a little higher. But what's the amount it'll go higher by is so much smaller than how much it can come down. That's what I want you to understand. So if you want to protect your funds, or you want to, cash in on your profits, it's time to think about how do you navigate this overextended market, right? So I want you to understand that. The other thing that's important is when you look at the drop that happened in March, and if you looked at it in terms, like a good word to describe this would be like in a forensic manner, right? If you were to look at the charts, you'll see that in 1 week, the market drop took out like 9 months or 10 months of upward movement. In 1 month, it took out maybe a few years of upward movement. That's how you know that you're not ready when this thing really crashes. Because when you have a market that's gone up for 13 years and has what we call good volatility, and I've gone over sessions on that and video lessons on that, where in terms of describing volatility, there's good volatility, there's bad volatility. Volatility is good, but you need to know how to identify which will help you make money and which will cause you to lose money, right? So what we witnessed in March was that a market that went absolutely insane and had bad volatility. Because if you can drop in 1 month, like a few years worth of movement, it's telling you something. The market is bellowing out to you, like neon signs in Vegas. It's kind of telling you, watch out, be careful, find a way to protect yourself, okay? The next thing that I want you, all the viewers to understand, is once the market dropped from around 28,000 or 29,000 to a little over 18,000 or a little below 19,000, the market had a quick recovery, right? A significant recovery. But here's what's important. The recovery was not based on anything fundamental. Nothing fundamental. The recovery has been made simply based on a Federal Reserve that's willing to print money, on a government that's willing to give relief to people in order to, again, in my words, to just prop up a stock market, because as soon as the stock market drops, everyone gets so scared, right? Now, Obama administration did this, the Trump administration is doing this, you can go back in time. That's the problem. Whenever you have this market, when a market wants to naturally correct and come down, our governments, our monetary systems, not just the United States, across the world, the European Union, most Western countries, wherever they are, they want to artificially hold up a market. And in my opinion, somebody is going to pay the price for that down the road, okay? Because there's not, you may think there's, we can keep printing money, we can keep printing money, but if you really understand markets, and I also go over this in my sessions and videos and things like that about my philosophy when it comes to markets. Markets are limitless. So at one time, there won't be enough money to print to save it, okay? You just have to let that naturally happen. You should be okay with a stock market that goes from 6,600 to almost 30,000. Let it drop, let it have its mathematical corrections, and then go back up naturally, okay? So that's something that I want you to pay attention to, because on this bounce up, we've had the market come to around the 26, 27,000 level, and you can see how it's barcoding right there, right? Going up and down, up and down, up and down, up and down. That's because that's the resistance. Now, if the market participants decide that coronavirus could extend, the post-COVID economy will not look like anything similar to the pre-COVID times, then you can have a massive crash. And if you look on a chart, this could be the second wave that can go below the low that was created in March. So that's something to keep in mind. And if you did not get out of the stock market, even in portions, I would recommend you start looking at your account and figuring out how do you protect yourself if another massive crash happens. Just talked about the equity markets, and we had kind of like a 30,000 foot view of it, and we looked at what happened in March and what's going on now. Let's look at the gold and silver market, okay? And let's talk about gold and silver because, historically, gold and silver have always been inversely correlated to the stock market. And what I mean by inversely correlated is that usually when the stock market goes up big, right, gold and silver comes down, or precious metal prices come down. When the stock market comes down significantly, usually gold prices go up significantly and silver follows, okay? And I'll get into that and in terms of how they do it. If you've been trading and you're experienced and you understand markets, however you understand them, because there's different ways to understand them, you'll know that there are times when the stock market goes up and gold and silver prices go up. And there are times when the stock market comes down and gold and silver prices come down. So I want to dissect that a little bit, because within that time frame, there's a portal, it'll tell you what's about to happen. And I think it's important to understand that. So here's how I'll explain this. Usually, when the stock market goes up and it's in a bull market or it's in a bull trend, like you had a 13-year bull run, gold prices should come down. And that's exactly what happened. You can see that after gold created a record high in 2011, it ran up from 2008 to 2011, about 300% or higher, right? That's what gold went from $685 an ounce to $1,921 an ounce from October 2008 to September 2011. Then, as the stock market started going higher and higher and higher, naturally on a mathematically based massive bull market, fed by a Federal Reserve that loves to print money, okay, gold suddenly started coming down significantly. So gold came down from $1,921 to a little over $1,000, actually about $1,030, $1,050, right? So a big drop. That's normal because that's how markets are. Markets are cyclical. They'll have their bull cycle. Then if you don't get out, that's your own problem. Okay, that's why we help you by letting you know and giving you the education to identify when a market tops out and how to get out of it, when a market bottoms out and how to get into it, right? But then gold came down and the stock market kept going higher. Normal, inversely correlated relationship. Equities go higher because it's more speculative. Precious metals like gold come down because the safe haven requirement is not there, right? Now here's what's interesting. If you go back and watch one of our videos from late 2019 or mid to late 2019, you'll notice we started talking about gold again. And we were saying, hey, we're seeing something that's weird, that's abnormal. Now, in life, sometimes weird and abnormal might scare people. But in the markets, weird, abnormal are good signals. They actually tell you that something's about to happen. And I'll tell you what we saw. As the stock market was creating new record highs in 2019, the gold market was breaking through resistance and creating new monthly highs or new quarterly highs. Not record highs, but it was coming on, it was showing us that it was done with the bear market of dropping, and now it's ready for a massive run. Strange. That's what I call the canary in the mine principle. And what I mean by that, if gold goes up, when the stock market creates new record highs, that is the sign that a few months later or a few quarters later, I'm not someone here who predicts exactly when something's going to happen. I can never do that, right? If you want that, you need to figure out somebody else to talk to. But what I mean by this is, when I noticed that, then we knew that sometime down the road, the stock market's going to drop big. And guess what happened? In March of 2020, after gold had gone up quite a bit, about maybe 20% or so, which was weird, gold was going higher when the stock market was creating record highs, the market drops 10,000 points. 10,000 points. Canary in the mine. Canary in the mine. Okay, so always pay attention to gold going higher, and usually it'll happen during the last phase of a bull market in the stock market. Okay, now some people ask me, hey Mukarram, when gold's going higher, how come silver didn't go higher? I was like, a very good question, but that's also normal. Silver usually is never the front runner in the precious metals market. Gold is the front runner. It's the leader of the complex, and it'll start going higher. Silver will follow. And just like in 2008, I traded silver in 2008 as well. In 2008, silver was trading between 16 and 19, 16 and 19, 16 and 19. Frustrating range for most people. But the moment it closed over $20 on a Friday afternoon, sometime in 2008, silver just blasted higher. Guess what? Same thing just happened. Just about a week and a half ago. For the last whole year, silver was between 16 and 19, 16 and 19, coming down to 14, going back to 19, coming down to 12, going back to 19. But then, last week, on a Friday afternoon, closed over $20 and blasted to 26 within 3 days. That's the sign that silver could have a massive move up. So this is very important, guys, okay? Some things that have happened. Number one, the stock market is no longer, in my opinion, in a bull market. It has come down, shown you how strong that drop can be, and is now bouncing higher, right? But it's nowhere close to being a new bull market, okay? I wouldn't call it that. The gold market is definitely in a bull market. Why? Because gold has gone up as the stock market was going up in the middle of 2019. Then gold just blasted through resistance. 1380, 1400 was a resistance. It just went through like a hot knife through butter, through that, right? Then at 1680, 1700 was a resistance. Went through that after it came back a couple times. And now, just a few weeks ago, created a new record high, over $1,921. It's gone over $2,000. Now, a lot of people asking me, well, Mukarram, is gold too expensive? Okay, that's the word I want to say. Is it too expensive to get into? Is silver also, because it's gone from 20 to 26 so fast, is it too expensive to get into? So I really want to dissect this way of thinking so that you can change and become very powerful in your way when it comes to managing your money, okay? Number one, there is no such thing in the market as expensive. Never. Why? Because a market never cares about a numerical price. It's only human beings like us, we care about the numerical price because we have an emotional reaction to a numerical price. So if gold is at $3,000, we think, oh my God, that's expensive. If gold's at $200, we think, oh, that's cheap. Because gold hasn't been at $200 since like when I first got into the business in 2005. You know what I mean? The other thing is as we grow up in our life, in our societies, in our schools, our parents, our life, we've been taught to think of expensive and cheap, expensive and cheap. Markets don't care about that. Why? Because markets are limitless. When something is limitless, it doesn't have an attachment to numerical price. But when you don't have limitless funds, you have an attachment to numerical price. That's why our teachers, our parents, our mentors, all of us taught us limits or expensive and cheap. So I always try to change that philosophy when we look at markets, and hopefully we're making that effort. We'll keep doing video sessions, lessons, whatever it is necessary to help people change that, because when you change that mentality, you unshackle yourself. And then there's a beautiful world out there for you to experience and to grow and to help and everything, okay? But getting back to the gold and silver, here's an important thing that I want to mention to you. People ask me, is the price of gold too high? Again, a variation of expensive. Is the price of silver, has it gone up too much, too fast? Variation of expensive, right? Here's how I dissect this, and it may make sense to you, it may not. If you have more questions, you can always reach out to me. First, when we look at why gold and silver move, there is a general reason they move higher, because they have an inverse correlation to the stock market. So if the stock market goes down, gold and silver will go up, like they did in 2008, 2000. Then what I do is I go back and look at what were the reasons that caused the stock market to drop, or let's say an economy to crash, whether it's in the United States, in Europe, or in some major economy like China or India or something, right? When we look at the 2007, 2008 crash, there were two major things that happened that caused gold to go up. Number one is there was a subprime mortgage crisis. I know, people should never be buying 3 houses when they can't afford it, okay? But they did it. I know friends who bought houses and the bank couldn't prove that they owned it because the bank had sold their mortgage 3-4 times, okay? That's the weird paper world that we live in. But that's what happened. So subprime mortgage crisis unfolded. And then from there, you had the stock market crash because there were bankruptcies and there was debt and there were IOUs and so many things that happened, right? Okay, but there were 2 reasons, pretty much 2 reasons. Subprime mortgage crisis and the stock market crashing. Gold went to a record high, 300+%. Silver went up 400+%. It went from $8.50 an ounce, $8.50 an ounce to $49.50, almost $50, okay, from 2008 to 2011. This time around, people, please pay attention to this. This time around, look at the triggers. Number one, before coronavirus, forget coronavirus, last year, US-China trade war, trade tensions. Then going into a year where you're going to have presidential elections with a very, however you feel like, whether you like Trump, whether you don't like Trump, I mean, I don't get into that, right? But with a very polarized United States. But here's the important thing. So US-China trade tensions. Then you have this presidential election, major, massive event coming up, this year. Then you had the unfolding of the disaster, the coronavirus disaster. Started in China, and then kind of like spread across the world and across the pond, came to the United States. I was actually in London in January when things were going on, and we didn't really notice that it was coronavirus. We didn't really think it was coronavirus. And then when I came back, suddenly everything happened, okay? Very, very interesting time. And, hopefully in later sessions I can, talk about that. But here's the interesting thing. Coronavirus is very different to anything else that has happened in the near-term history in the United States. Because what coronavirus did was literally shut down the US economy, literally shut down how we live our lives in the United States. And I want you to understand why that's so important. Because the United States is a consumer-driven society. In 2008, when the market was crashing, I could still go to the restaurants. I could still go spend money. I could still buy things on my credit card and go out and spend money. Today, I live in California. In Orange County, California, you go outside, you hardly see anybody. I talk to friends from Florida, from New York. I talk to clients across the country. Everyone's telling me the same thing. This is what I call street sense. If you have street sense, you'll know that this time around, in a country that was built around consumer spending, consumer-driven economy, and a debt-driven economy, by the way, which I don't like, but that's what it is. It's a debt-driven economy. We can't spend money. And if you can't spend money, then it's going to affect this country in time, right? It's going to affect the economy. That's why I call it a post-COVID economy. How would that look like? Warren Buffett gave a very interesting, I would say, a window into it, right? Because like a month ago or 2 months ago, I don't exactly remember when he had his conference, he said he was getting out of all airline stocks. I know airline stocks have come back up, but why is Warren Buffett getting out of all airline stocks? Because he thinks that traveling has changed forever. Today, I had a couple friends of mine fly out from the United States, and for a week, it was difficult for them to schedule their testing and then get on a plane. They had to cancel the flight, get back on because they needed to test for 48 hours. And then inside the plane, each seat is empty because that's how it is. Strange world. We've never lived in that world before, especially in the United States. Maybe in some other, third world economies and things like that, you can go through that, but not here. So this is a massive, massive fundamental factor that doesn't just happen and go away. It's not like an election. It's not like a war or a bomb or some kind of activity, something happened. No, it's something that's consistent. The next thing that I want you to focus on is if you look at all this, it's like a perfect storm of events, fundamental events. So when people ask me, how high can gold go? Please understand the markets are limitless, okay? There are estimates out there of $3,000 gold, $5,000 gold, all those numbers. I'm not sitting here and telling you a number, but what I want you to understand is if gold went up 300+% from 2008 to 2011, silver went up 400+% in 2008 to 2011, imagine where it could go with all of this perfect storm of events unfolding. That's why you're seeing gold at a record high. That's why you see silver blasting in the 20s, right? There's a lot of room because silver's record high is close to 50. So there's a lot of room. So there's a lot of opportunity, okay? So that's something that I wanted to make sure that people understood because there might be this confusion. When prices are high, I don't want to get into it. Well, in any healthy bull market, you'll see a market go up maybe 5 steps in a row, come down 2 steps, then go up another 5 steps. So it takes out its previous high, comes down, takes out its previous high, comes down, takes out its previous high, right? Just like a stair step kind of way. And that's what we're seeing. So don't be afraid of numerical price. Don't worry about whether gold's at 2,000 right now or 2,500, silver's at $25 or $30 or $40. Don't worry about that. Look at the fundamentals and the mathematics of how high this market can go. Okay? And if you have any questions, please reach out to me on that. Thank you for spending your time with us and learning about the markets. Hopefully the information presented was beneficial to you. Please like and subscribe to our YouTube channel below and be sure to check out Bullionite.com for more actionable information that can help you attain your goals. Wishing you a happy and successful investing and trading.
Content is for educational purposes only. This is not investment advice from Bullionite LLC. There is always risk for substantial losses in investing and or trading through any financial instrument with or without this or any other type of advertised product. Past performances are not indicative of future results. Different types of investments involve varying degrees of risk. Specific strategies or education presented by Bullionite LLC and its associates in this video are for educational purposes only.